Hey, welcome back to High School Economics. This is Dr. Kling, and today I'm going to talk about the relationship between interest rates, investment, and net exports. Now, in principle, we could do this using additional equations. I could write down more equations for these things, but instead I'm just going to sketch out the general direction of the effect of interest rates on investment and on net exports. So let's start with our identity, but we're going to include net exports now. Oops. Y equals C plus I plus G plus X minus M. So X is exports and M is imports. And the difference between the two we call net exports. Okay, well, let's go back to I. So I'm going to say when R goes up, investment goes down. So all these arrows here, this up arrow means that an increase in something, a down arrow means a decrease in something, and I use this arrow here to show causality. So interest rates going up causes investment to go down. That's what all these symbols mean. So the thinking is that remember when we raise the interest rate, that increases the opportunity cost. So R going up means that you have a higher opportunity cost for purchasing capital goods. So when the interest rate goes up, you either have to borrow more money, or if you're using up savings, and you took your money out of the bank, you'd be giving up more in terms of interest that you could have earned on that savings. So any way you look at it, there's a higher opportunity cost for purchasing capital goods, whether they be buildings or machinery in a business. So that's why when the interest rate goes up, we see everything else equal, we'll see investment be lower than if the interest rate had not gone up. So that's this story. And now I want to talk about how the interest rate affects net exports. And now I'm going to have a sort of a complicated cause and effect story. So first of all, when the interest rate goes up, the demand for our securities goes up. And securities are things like bonds and stocks. And I'm going to put, let me put international demand. So when our interest rate goes up, if our interest rate is higher than the interest rate in other countries, then people in other countries think, well, we should invest our money in the United States where we can earn a higher return. So that's why there's this relationship. When our interest rate goes up, it makes our investing in our country more attractive to people in other countries, and so they're going to increase their demand for our securities, our bonds, and our stocks. When the demand for our securities goes up, that raises the value of the dollar. Okay, because people are trying to get hold of dollars so that they can buy our bonds and our stocks. So that raises the value of our currency. When the value of our currency goes up, that means that our goods and services become more expensive in world markets, right? Because it costs other people more hours of work to earn the money that they would need to get hold of dollars, because the value of the dollar has gone up. So our goods and services have become more expensive, and so our goods more expensive means what in terms of our exports? Well, it means that we're going to export less. And what about imports? Well, if our goods are relatively more expensive, that means that foreign goods are cheaper. So if our value of our currency is really high, then foreign goods are cheaper, and so imports will go up. So what we've gotten is a long chain of events in which the interest rate going up means that the value of the dollar, if that's our domestic currency, goes up. And that means that our exports go down and imports go up. So overall, when interest rates go up, we have investment going down. We explained that before because it raised the opportunity cost of buying capital goods. And we have exports down and imports up. So back to our identity. With C plus I plus G plus X minus M, if interest rates go up, then we know that this is going down, this is going down, this is going up. Therefore, GDP is going to go down. So that's the main message of what I wanted to talk about today, the relationship between interest rates and investment and net exports and how that affects GDP. We could set up equations that would show all of this. You can see that there would be a lot more equations, but what we're going to do from now on is get away from equations and algebra and instead represent things in diagrams. And I'll start to do that next time.